Today, we will talk about how to pick stock and invest properly. So before we get started, make sure to hit that like button, also subscribe to my channel. Select an online stockbroker. The easiest way to buy stocks is through an online stockbroker. After opening and funding your account, you can buy stocks through the broker's website in a matter of minutes. Other options include using a full-service stockbroker or buying stock directly from the company. Opening an online brokerage account is as easy as setting up a bank account. You complete an account application, provide proof of identification, and choose whether you want to fund the account by mailing a check or transferring funds electronically. Research the stocks you want to buy. Once you've set up and funded your brokerage account, it's time to dive into the business of picking stocks. A good place to start is by researching companies you already know from your experiences as a consumer. Don't let the deluge of data and real-time market gyrations overwhelm you as you conduct your research. Keep the objective simple. You're looking for companies of which you want to become a part owner. Warren Buffett famously said, "Buy into a company because you want to own it, not because you want the stock to go up." He's done pretty well for himself by following that rule. Once you identified these companies, it's time to do your research. Start with the company's annual report, specifically management's annual letter to shareholders. The letter will give you a general narrative of what's happening with the business and provide context for the numbers in the report. After that, most of the information and analytical tools that you need to evaluate the business will be available on your broker's website, such as SEC filings, conference call transcripts, quarterly earnings updates, and recent news. Most online brokers also provide tutorials on how to use their tools and even basic seminars on how to pick stocks. Decide how many shares to buy. You should feel absolutely no pressure to buy a certain number of shares or fill your entire portfolio with a stock all at once. Consider starting with paper trading, using a stock market simulator to get your feet wet. With paper trading, you can learn how to buy and sell stock using play money. Or if you're ready to put real money down, you can start small, really small. You could consider purchasing just a single share to get a feel for what it's like to own individual stocks and whether you have the fortitude to ride through the rough patches with minimal sleep loss. You can add to your position over time as you master the shareholder swagger. New stock investors might also want to consider fractional shares, a relatively new offering from online brokers that allows you to buy a portion of a stock rather than the full share. What that means is you can get into pricey stocks with a much smaller investment. SoFi Active Investing, Robinhood, and Charles Schwab are among the brokers that offer fractional shares. Many brokerages offer a tool that converts dollar amounts to shares too. This can be helpful if you have a set amount you'd like to invest, say $500, and want to know how many shares that amount could buy. Choose your stock order type. Don't be put off by all those numbers and nonsensical word combinations on your broker's online order page. Refer to this cheat sheet of basic stock trading terms. With a market order, you're indicating that you'll buy or sell the stock at the best available current market price. Because a market order puts no price parameters on the trade, your order will be executed immediately and fully filled, unless you're trying to buy 1,000,000 shares and attempt a takeover coup. The market order could also not be fulfilled if you were attempting to purchase a very thinly traded stock with little volume. Don't be surprised if the price you pay or receive if you're selling is not the exact price you were quoted just seconds before. Bid and ask prices fluctuate constantly throughout the day. That's why a market order is best used when buying stocks that don't experience wide price swings. Large, steady blue-chip stocks as opposed to smaller, more volatile companies. A market order is best for buy and hold investors, for whom small differences in price are less important than ensuring that the trade is fully executed. If you place a market order trade after hours, when the markets have closed for the day, your order will be placed at the prevailing price when the exchange is next open for trading. Check your broker's trade execution disclaimer. Some low-cost brokers bundle all customer trade requests to execute all at once at the prevailing price, either at the end of the trading day or a specific time or day of the week. Dollar cost averaging means repeatedly buying stocks at the market price on a regular basis. For example, by investing a set amount of your paycheck into an index fund every 2 weeks. It's technically not an order type, but much like a limit order, it's a way to reduce the average purchase price of your investments, also known as your cost basis. If you dollar cost average by investing a set amount of money into an index fund every 2 weeks for a year, your cost basis will be the average price of that index fund over that year. If you invested all of that money at once, on the other hand, there's a chance you'd buy in when the fund's price was at a yearly high. That would give you a worse, in other words, higher, cost basis than dollar cost averaging. Optimize your stock portfolio. We hope your first stock purchase marks the beginning of a lifelong journey of successful investing. But if things turn difficult, remember that every investor, even Warren Buffett, goes through rough patches. The key to coming out ahead in the long term is to keep your perspective and concentrate on the things that you can control. Market gyrations aren't among them, but there are a few things in your control. Once you're familiar with the stock purchasing process, take the time to dig into other areas of the investment world. How will mutual funds play a part in your investment story? In addition to a brokerage account, have you set up a retirement account, such as an IRA? Opening a brokerage account and buying stocks is a great first step, but it's really just the beginning of your investment journey. Know when to sell stocks and when not to. You can sell your stocks when you're satisfied with the profits they've made or when you need the cash. Ideally, you want to set specific long-term goals for your investments so that you check both of those boxes at the same time. If you're purchasing stocks, it's a good rule of thumb to avoid investing money you'll need in at least 5 years. That's due to stock market volatility. It's possible the value of the shares you buy will go down before going up. You could consider selling your stocks if you need cash and they've risen in value, but doing so means you may pay capital gains taxes on the sale, and you may miss out on future gains over time. Perhaps what's more important is to consider when not to sell stocks. When the market is falling, you may be tempted to sell to prevent further losses. This is widely recognized as a bad strategy, as once you sell, you'll lock in the losses you've incurred. A strategy many financial advisors suggest is to ride out the volatility and aim for long-term gains with the understanding that the market will bounce back over time. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.